Good morning. My name is Victor. Welcome to Financial Accounting class for SS1 week 3. Last week we looked at profit and loss account, the account of a trading company, and we were able to look at some examples, look at some key definitions in profit and loss account, look at how we ascertain our gross profit and our net profit. Now this morning we'll be looking at balance sheet. At the end of this lesson, we should be able to define balance sheet, list the types of assets, list the types of liabilities, and give examples of assets and liabilities. Alright, now what is balance sheet? A balance sheet is an account prepared by a company who is in business, stating the financial position as regards asset and liability at a particular date. Balance sheet is looking at the what and present position an organization is occupying at a given date in order to know its level of financial activities and what it has resulted to. Now, when we look at balance sheet, our major objective of preparing balance sheet is to look at the what of the organization. Has the organization done well for the past 1 year? Or depends on the period that the balance sheet is covering. Has the organization traded well? Has the organization been able to keep proper books? From the balance sheet, you will know if there are expenses or income that are overlooked or that are not properly captured in the account. And if such information is not complete, discover that your balance sheet will be one-sided. So that is why when we are preparing balance sheet, we must capture every income and expenses just as we post them in our profit and loss account, because they all have a role to play in preparing balance sheet. Now, when we say a particular date, balance sheet is not like profit and loss account that measure transaction for the year, for the whole year, but rather is measure the worth of the company at a particular date, the state of transaction at a particular date. That is why in balance sheet we use the word as at. We don't use for the year. We use the word as at. We don't use the word for the year. So we must be careful also, so that when we get to the preparation, the format, we will look at all of that again. Now, a company who is in business, if you want to say acquire another company, the first point of call is to look at the balance sheet. Let us see what is the level of asset and what is the level of liabilities. There are other ratios you also compute to value the business using picking your parameters from the balance sheet. You look at your quick cash flow risk, where you can assess your risk, your indebtedness, the level at which finances are being utilized, and all of that. From there, you will know whether a company is actually over trading or under trading, and a lot of other. But we'll leave that to when we are doing proper computation as regards to preparing balance sheet. Okay, all right. The components of a balance sheet. A typical balance sheet is made up of the following components. We have the assets. Now, in the asset, we have fixed assets, we have current assets. Those are the two types of assets we have. Fixed assets, as a result of transition now, it's now called non-current assets now. Okay, but I believe at your level, it can still be called fixed assets. Then we also have the current assets. Now, fixed assets are those assets that the company use in the course of running their business. Now, most of these fixed assets are called fixed assets because they are not held for sale. They are not held for sale. They are not converted into finished goods. You don't see a physical reduction in its value as a result of production. because they are being converted. No. But you can only see reduction in value as a result of depreciation, depletion, and all of that. So they are more or less like immovable assets. Then the next type of asset is the current asset. The current assets are those assets that the company owes to himself. This company uses this asset to run the business. To run the business. Those are the things that are converted into finished goods. Those are the things that are put together to create what the company wants to sell, what they want to produce, their end products. That's for current assets. Now, liabilities. We have short-term liabilities, we have long-term liabilities. These liabilities are those things that the company owe. It is not their own. They can either be borrowed or be sourced for. But now, short-term are those ones that the company can hold to be using for a period no more than 1 year. For a period no more than 1 year. Like when we look at the issue of overdraft, like creditors, somebody supply you goods on credit you have not paid, or you have the goods to be using to produce. After production, before the end of the year, you are supposed to sort it out. You pay them back and all of that. Then you also have the long-term liabilities. The long-term liabilities are those ones that you hold for more than 1 year. For example, when people invest in your bonds, you take fixed interest loans, long-term loans, and all of that. You use all of that to finance your business. They are not your money. They are not your money. They are just borrowed. So they also come with a cost, because certainly you will pay for them. You will pay interest. Probably at the end of the tenure, you have to pay off the whole sum. Depends on the arrangement you are having with the lender. Is that okay? All right, let's look at the third part of a typical balance sheet. The third component. Now, the third component is the capital. This one we refer to it as the owner's fund. Now, this is made up of initial amount invested. Initial amount invested. As at the time you were starting your business, what do you have? Not the one you borrow from the bank, no. Because the one you borrow from the bank is not your money. So it cannot form part of your capital. It is the one you have been able to save on your personal ground, the one you have been able to get from friends and family that you are not paying back. It can also come as a result of people pulling their funds together. Let's assume in the area of partnership, 2 or more persons coming together, they will bring their money together. Nobody is owing anybody. So we all have agreed to run the business together. I am not borrowing you, you are not borrowing me. We are only borrowing the company. So we are putting this thing together. It becomes the startup capital for that business. That's what we call the initial amount contributed. Now you have reserve generated. You know, when you make, after you prepare your profit and loss account, you have removed all your expenses, you have gotten your net profit. Like in a company where they pay they pay dividend to shareholders. You have removed your dividends. You now say, okay, this one is reserved for reinvestment. The one you reserve for reinvestment at the end of the year. This one you are applying it back into the business. That's what we call reserve. So it's also form part of your capital. You add it to your capital. Then there's what we call drawings. Drawings are those expenses that are made by the owner of the business, but it does not relate to the business itself. For example, an MD of a company taking money from the company to pay his children's school fees. that does not contribute anything to the business, because business is a separate entity. It cannot be carrying cost that is not its own. So automatically, MD have directly reduced his investment in that company. That's what we call drawings. So by this explanation, you obviously know that drawings is a deduction. You less it from your capital. It will reduce your capital. Now, when you look at a balance sheet, you see that, like the T format, we have the debit side, we have the credit side, or let me say we have the right hand side and the left hand side. The right hand side will take care of all the assets, both fixed assets and current assets. You would give you a total. Then on the left hand side, you have capital, you have liabilities. So capital plus liability should or must be equal to your assets. That is why in the accounting equation, we will look at, say, asset is equals capital plus liabilities. Capital plus liabilities. Now, just as I explained, what are those things that make up your capital? Amount invested in the business, your reserve, your profit and loss for the year. Then you remove your drawings, you have your capital. The liabilities are those both short-term liabilities and long-term liabilities. Those are your liabilities. Now, when you want to calculate capital, just a normal accounting equation or make change of subject formula now. But always know that since asset is bigger than either capital or liability, so at every point you are looking for or calculating capital, asset will come first. That's why in equation 2, we say capital is equals asset minus liability. Then when we are now looking for liabilities, we will also say asset minus capital. So that is the accounting equation. All right, now let's look at assets. What are assets? This asset we'll be talking about, what is it? What is this asset? Now, meaning, these are properties owned by the organization for the purpose of running the business for a specific lifespan. Now, own, it is their own. They were purchased by them. All right. Peradventure, a company now decide to lease an asset. When a company now decide to lease an asset, which is also possible, if it is a finance lease, then the company has a right to incorporate such asset into their fixed asset column. But if it's an operating lease, the company does not have the right to have such assets into their asset column. But we're not, suppose we probably will discuss leasing, then we'll be able to look at substance over form in all this area. Is that okay? All right. Now, the two types of assets that we discussed earlier. Now, let me specifically define what fixed assets are to you now. They say fixed assets are those assets that the company are holding for a duration other than 1 year and not held for sale. They are not held for sale. They are using it to generate income. They are using it to run the business. It is not held for sale. You cannot sell it in the ordinary course of business. Now, I am not saying you cannot dispose. You can dispose of. You can dispose of when an asset is old, when it is fully depreciated, or it is no longer relevant to the business, maybe as a result of invention and all of that, or as a result of technological advancements. So you can decide to dispose of. So We also probably with time we also discuss how we treat those assets that are being disposed. But let me just quickly say this, that when an asset is disposed, the year at which it is disposed, you less it from your total asset. Less it from your assets in full. That is at net book value. At net book value, not at cost, because those assets would have been depreciated with time in your account. So it may not have been carried the same value as it was carrying when it was purchased in your books. All right. That is for assets. Now, what are these type of these assets now? If you want to look at examples of fixed asset, let me just quickly list one or two. Like plant and machinery, like building. So people will say land and building. Okay, land and building or building. Like furnitures and fittings. All those are fixed assets. Like motor vehicles. So all those ones are examples of fixed assets. Now let's go to current assets. Current assets are those assets held for the running of the day-to-day activities of the business. It is held within 1 year. Now, these assets are what the company owes. It is their own. For example, when you look at stock, when we say stock, we mean materials. These materials are in three forms. You have raw materials, you have work in progress, and we have finished goods. The raw materials are the ones that have not been processed at all. The work in progress are the ones that they have done partial processing but has not been completed. Then we also have finished goods. Finished goods are those ones that have been produced but has not been sold as at the time you are preparing your balance sheet. So all of that now, you put together to form your stock. Then you have something like debtors. Now we call it receivables. Debtors are those that you have sold your goods to but have not paid you. At what point do you ascertain these debtors? At the point at which this account is prepared. That is at the end of your financial year. The debtors you have at the beginning or at the middle of the year may not be the same debtors you have at the end of the year. Some will pay, some other will come and buy and not pay and all of that. So it will continue to change until the day you are closing your account and say on 31st December 2015, I am closing my account. So every debtors you have that day, as at that day, will be captured as your total debtor for that account. The things like your cash, how much cash do you have in your hand that you have not taken to the bank, we also classify all those ones. The one you have in your bank account, how much do you have in your bank account? Those are all assets. Now, another current asset that is a little bit silent is prepayment. When you make payment for services that have not been enjoyed, okay, you have made payment. So the people, they are owing you service. Or you have made payment for material that have not been supplied. It becomes payment in advance. It can either be called payment in advance or prepayment. So all of that put together will form your prepayment. So automatically it's an asset to you because it has not been enjoyed. So those are the two classes of fixed of assets, fixed and current. Is that okay? I say two types of assets. We have fixed assets and current assets. All right. Now, just as I said, we also have liabilities. These are resources owed by the organization for the purpose of running the business for a specific lifespan. Now, when I say specific lifespan, just as I explained in assets, there are some that are within 1 year, there are some that are more than 1 year. Okay. Now, when we look at a typical balance sheet, I will be able to explain some of these terminologies again when you begin to see them in the question or in the format. Is that okay? All right. Now, liabilities are those things that the company owe. It is not their own. It can either be borrowed or they are being owed to third party or to outsiders. Okay, those are liabilities. All right, let's look at types of liabilities. We have the short-term liability, we have the long-term liabilities. Short-term liabilities are those liabilities that the company are holding for a duration of within 1 year in running the business with a cost associated. Now, when I say cost associated, there is always a cost at everything that is being owed. I know you start asking me, what is the cost associated to creditors? All right. The cost associated to creditors, that is when you buy things from someone or from an organization and you have not paid, the cost associated are those costs that when your liabilities become too high, when your creditors become too high, you may not get for that credit. So that is one of the major costs that's associated with creditors. 2, you may have enjoyed discount for paying cash, but if you owe, you will not enjoy that discount. That is another cost. So there are other liabilities like bank overdraft. You know, you pay interest on overdraft. Then when you have accruals, activities that have been enjoyed but have not been paid, like when you have salaries that are not being paid, that you have tax that have not been paid. So all of that will put together to form your accruals. Those are your liabilities, your short-term liabilities. Now, long-term liabilities. Long-term liabilities are those liabilities held by a company for a cost whose duration is more than 1 year. Now, duration is more than 1 year. This also has a cost. For example, bond. When you sell bond, when you borrow money, when you take debentures, you sell out your debentures. When you sell your debentures, people pay you cash, then they are holding your security. So all of that normally is not a 1 year transaction, but if there is an element of or that can attribute it to a 1 year duration, it becomes your short-term liabilities, irrespective of the name it is called really, but if it is within 1 year. Now, when a bond is purchased and you have been paying, and this year become the last year that you want to pay off the balance, you cannot judge it by how it started. Rather, you are judging it by how it's ending. If it has a duration of less than 1 year, automatically it will move from your long term to your short term. Because when you are calculating your solvency, you are using short-term liabilities against your current assets. So if you don't capture it in that manner, it will look as if you are trying to hide that liability. And the more you hide liability, the more you look solvent, whereas that is not the true position of the company. So that is why we are taking our time to look at the items in the balance sheet. So when we are solving, you obviously see all of that. Is that okay? And I'm glad that you enjoy this class. Please, I want you to go over it again, read it again and again, and see how far you'll be able to grab some things. Always learn to pause at every time. Always learn to pause at every time. Always learn to pause at every time and copy your notes. So in our next class, we'll be looking at balance sheets, the format. We'll look at the format of a balance sheet. and look at those items that are stated in the balance sheet, those very common items and those ones that you may not have seen before. Thank you very much, and this is the end of the class. I'll see you in our next class.